man, when I tell you a video is going to make you a ton of money, I hope you take it serious. What we're going to discuss here in this video is the economic slowdown that is currently underway that Wall Street has not picked up on yet. Specifically, what you can do to profit from this information. I will share with you my plan and my strategy that I am employing. But again, keep in mind, I am not a financial advisor and I am subject to be wrong. 3 specific topics that we will cover in this video. Number 1, what is going on with the consumer and the economy right now that has me and others like Meet Kevin, everyone besides the Fed and the perma bulls, pretty concerned. Number 2, what could be the saving grace for the markets and basically what you need at this point to get stocks to go higher from here. And last, but certainly not least, what I am doing to my portfolio right now, potentially what you should look into doing and, well, in the hopes that you make a lot of money, aka how to hedge your portfolio. But again, keep in mind I am subject to be wrong and I am not a financial advisor. So first things first, I will give you a quick rundown. I did make a 30-minute long video on this specific first topic yesterday. So check that video out if you have not seen it. If you've seen that video, well, this video is a great continuation of that video. But in the last video, I talked about what happened in the past a lot. What you're seeing right now sounds eerily familiar to what you've seen in 2007 and 2008. So what started to happen in 2007 was around July, August, September or so, you started to get some fears about the consumer slowing down and potentially the US economy going into a recession. And then what preceded this period was a very fast weakening in the consumer. Just as an example, this article was posted by the New York Times, September 29th, 2007. It reads, "Consumer spending rises, easing fears of a slowdown. Personal spending rose a better than forecast 0.6% last month." About 5 weeks later, Ben Bernanke, which was like the Jerome Powell today, the head of the Federal Reserve, warns Congress of an economic slowdown. That was on November 8th of 2007. And then this article came out a couple weeks later on January 14th, 2008, that says Americans cut back sharply on spending. The abrupt pullback raises the possibility that the country is experiencing a rare decline in personal consumption, not just a slower rate of growth. This article goes on to say there are mounting anecdotal signs that beginning in December, Americans cut back significantly on personal consumption, which accounts for about 70% of the economy, when in all reality, you had seen personal spending slow down before December, but it wasn't as obvious. And get this, consumer confidence, an important barometer of economic health, has plunged. And they said at the time, consumer satisfaction with the economy has recently hit a 15-year low. Now, this is Michigan current economic conditions. We just got this yesterday on Friday. Their number that they are referencing for December of 2007 was a number of 91 points, okay? The number that just came in yesterday came in at 68.8. The number we had in February of 2020 before the Rona was almost 115. You are in the dumpster fire, and the dumpster has exploded and simultaneously caught on fire and eroded with acid. This is bad. You also have recently seen the Conference Board leading economic index that has fallen sharply from its record high. And long story short, anytime this index has fallen over 5%, you have went into a recession. Now, this actually happened in December of 2021, so it's 28 months and counting, and we have not went into a recession. By the way, this happened in March of 2006, and then you officially were declared in a recession by December of 2007. You were actually not declared into a recession until like May of 2008. And by that time, markets have already declined most of the decline. But this was a 21-month period, so it's not too crazy to expect. I mean, this could eventually be a sign we are heading into a recession. But I think the number one thing that is eerily similar now to what you've seen in 07, right before shit hit the fan and started spinning, for lack of a better analogy, I like to use that one, and I think it gets straight to the point, is companies warning about the consumer slowing down. Back in 2007, you had Walmart, you had Target, you had high-end retailers, and most companies at that point saying, hey, the consumer's slowing down, and they're starting to slow down big time. And back in 2007, nobody really took it serious. Well, I'll be damned. What's happening today? Walmart, Target, McDonald's, Dollar General, Nike, Starbucks, basically any company you can think of is saying negative things about the consumer. I think the biggest problem that we have right now with the way the data is reported, it all lags behind. And even a lot of the data that we do get, a lot of companies don't even report what they're going through. So by the time we actually see, oh crap, earnings are bad, the economy's terrible, consumers are not spending as much money as they once were, it's probably going to be too late already. So that's number one. You're definitely going into a slowdown, consumers cutting back big time. And if none of that convinced you yet, take a look at the poll that we wrote on this channel. I wrote, how does the economy feel to you? 5% of you guys said great, spending a lot. 24% of you guys said it's okay, spending what I need to. 63% of you guys said bad, cutting back as much as possible. And 8% of you guys said lost my job or scared I'm going to lose my job. The ironic thing about this post on this channel is we're pretty bullish overall on stocks. So this is not like a doom and gloom kind of channel. That's just how you guys are doing in your day-to-day life. And I have to be honest, I was more optimistic about stocks before yesterday's Michigan Consumer Sentiment Survey was terrible and before the Fed was talking about whether or not we're at neutral. Like, the Fed needs to get a grip, and they need to get a grip quickly on what's going on in the economy and with the consumer, or we're screwed. When over 70% of GDP is comprised of people spending money, that's bad. So I think we have established the economy is slowing down. There is no exception to that. That's a definitive fact at this point. Now, here's the problem for the markets. We're getting into topic number 2. Problem is, stocks today are priced as if we are going to have a beautiful economy. We are going to have exceptional growth, this American exceptionalism, forever, for the foreseeable future. There's no slowdown in equities, at least not in the NASDAQ or the S&P on a headline basis. Markets are literally priced for perfection. That's why I think we're doomed for disappointment. And again, I reference this all the time because I think it's very relevant for a lot of people. But think about 2022. We never entered into a government recession. We had a technical recession in the first 2 quarters of 2022, but stocks bottomed in October of 2022. That was because overall consensus was we were heading into recession in 2023. What happened? Stocks recovered because from the market's perspective was, hey, this is about as bad as it's going to get. We should invest in stocks now because if a recession comes, we'll get back out. If a recession doesn't come, we're invested in the markets. That was the psychology towards the end of 2022. The recession inevitably did not come in 2023 and stocks did well. So just imagine if the markets start to price in a recession again. If we go, let alone go into one, okay, let's just consider we start to price in a recession. Maybe the odds go from 0% today because there's 0% chance of a recession baked in by the markets. Let's say that goes up to 50%, a coin toss for a recession late this year, if not 2025. Just to get back down to your 2022 lows, the NASDAQ would fall 43.5%. Now, you could be conservative. Maybe markets only fall 25% from here. That's still a huge decline. And that would put you back to about 330 on the NASDAQ, which is slightly under the lows that we hit in October and November of 2023, around 440. Hopefully you're catching my drift here. There's a lot of potential downside when the markets start to figure out the consumer is slowing down. Like, not a little bit of downside either. We're talking about 25 to 60% downside from here, depending on the severity of the slowdown, recession, no recession, where the odds of a recession go. And notice, I've not said anything about the Fed yet in this video. The Fed could either help us avoid a steep decline or could make it a lot worse. And what we're hearing from the Fed as of recently doesn't sound great. It sounds like the Fed is way behind the ball of this slowdown that is currently happening. I mean, Fed officials like Lori Logan and Fed Cook today suggested the neutral rate is now higher, and maybe Fed policy is not even sufficiently restrictive to bring inflation down. We're still talking about maybe needing to raise rates again over the next coming months. We're not even speaking about what's happening in the actual economy and with the consumer. So yeah, I'm not optimistic the Fed is going to help markets at all. I actually think if the Fed was going to prevent a recession, they probably should have cut rates at the last Fed meeting. Now, coming next week on Wednesday, you're going to get this CPI report. That is potentially your saving grace for the markets in the short term. If CPI comes in lower than expected, and retail sales come in still robust, then I could see next week being a pretty good week for markets. It could take some time for this slowdown to really materialize. If inflation falls faster than expected, that's going to be good news for markets. Worth mentioning, you have a speech from Fed Jerome Powell on Tuesday, so the day before CPI. Powell's probably going to already know what the CPI report's going to look like, and also retail sales. So if Powell strikes you as super dovish, like potentially warning in some degree about the economy, that could be a heads up for what to get tomorrow. I want you guys to remember this. If the economy is doing fine as markets perceive it is, if the Fed comes out and they sound overly dovish or overly cautious on the economy, it's going to spook the markets. At some point, the Fed being cautious about the economy and doing too much damage and, risking a recession, at some point that will be bad news for stocks. Does that happen on Tuesday? I don't know. Powell's probably going to get the data coming on Monday, the CPI report that's released to us on Wednesday, the retail sales that come out on Wednesday. Powell's probably going to get that by Monday. So by Tuesday in his speech, we're probably going to get some insight. So I'm paying very close attention to what Powell says on Tuesday, and I will bring you that information. So hit the like button and subscribe to the channel because you're not going to want to miss what Powell has to say. Last but not least, things that I am doing in my portfolio are, number one, selling stocks that I am up on, that I have positive gains on, that I would like to lock in profits on, that I'm not necessarily sold on the valuations of. Okay, I'm not going to give specific examples. If you guys want to come see the trades that I'm making, check out the link down below in the description of this video. But selling some stocks I have positive gains on makes a lot of sense to me. Keeping stocks like Tesla or Fubo or SoFi, these stocks that have already not participated in markets. 2022 was a bad year for those stocks. 2023 was a bad year for those stocks. 2024 has been a terrible year for those stocks. I don't want to sell them now because if we do go into some kind of recession or crash or whatnot, I think those stocks are already pretty well priced for that. And I think, yeah, sure, you go through the initial recession crash and then they will recover, okay? So I'm not interested in selling stocks that I have losses on, or big losses, or that are already at pretty steep discounts, like those stocks that I mentioned. I do like the idea of buying puts on our markets, but I think the NASDAQ and the S&P are expensive. Again, because I'm expecting by July, the markets could, be in a much lower place than they are today. But that's still months away from now. That's still almost 3 months away from now. So you're going to have to pay quite a penny for any options that expire towards the end of this year. But eventually I will look to buy some triple Q puts, maybe S&P puts. I do like single stock puts a little bit better. Some Apple puts make sense to me. People are not going to be spending on iPhones if they can't, if they lose their job, right? Certain companies like that. You could even say maybe Nvidia, because people think Nvidia is bulletproof to the economy. It's not a cyclical company, but semiconductors are always cyclical. If we do start to head into a recession, and when companies figure that out, the first thing they're going to do is cut back on their billions of dollars a year in AI spending. So I think Nvidia puts could offer a pretty attractive risk to reward, especially going out towards the end of this year. And keep in mind, any puts that I'm buying now, I want them expiring October, November of this year, if not next year in 2025. I'm not buying any weeklies here that I'm going to take serious. Not even a month or two out. I want multiple months out. Because what I'm really trying to do is capture the spread between, hey, markets are at 0% recession risk today. If that risk or odds from the markets jumps to 50%, stocks could fall 25% from here. That's what I'm trying to capture. I think that could happen in 3 months, 4 months. Now, you got to give yourself time on these options. If you are purchasing options, not a financial advisor, the best way to think about any hedge is if you make a hedge, it's a hedge for your overall portfolio, right? So if your hedge goes to zero, your portfolio should hopefully do well in that period of time. But you should always, if you're buying options, expect them to expire worthless and to lose all of the money you put into any of those trades. The trade that I actually like the most is in the bond market. Number one, because current expectations are you're only going to get one rate cut in 2024. Now, maybe 2 cuts, but really no more than that. I think by July 31st, that July 31st Fed meeting, you may get 50 basis point rate cut, maybe a 75 or 1%, 75 basis point or 1% rate cut if the economy is really in a rough place by July, in which I think there's probably a 50-50 chance that we are at that place. Now, TLT is the ETF that tracks the bond market. As you can see, when rates are low, 10-year treasury yields are low, for an example, TLT is high. And you hit 164 during the Rona crash when rates were cut to zero, and there was a rush to safety, right? There's always going to be a rush to safety in U.S. treasuries, at least for the foreseeable future, if there is serious worries about the economy. So TLT works by investors when they buy bonds for a rush to safety or want to lock in yields or the Fed cuts rates. TLT will go higher. That's really the long story short. Now, I like TLT because, one, it's trading at very low levels. It's not expected that we're going to get a lot of rate cuts. So if markets do start to expect a lot of rate cuts in 2024 or early 2025, TLT can go up quite a bit. You're also going to get a lot of firms that investors that want to lock in, 4% yields or 3.5% yields wherever the 10-year treasury is at that point. And I think that rush to safety could be a lot more evident at that point. There's also going to be some traders that try to jump into bonds for the capital appreciation because, again, when bond prices go up, that is capital appreciation. Even as your yield goes lower, bond prices go up. You make money on the face value of your bonds. So again, same is true with TLT. I like the TLT options that expire at bare minimum September, October, November, even into the first half of 2025. But if you guys want to see my specific trades that I am going to make, check out that link down below in the description of this video. I do think this TLT trade, hopefully I'm not giving it away too much, could be a once in a decade trade. if indeed the markets do, jump on recession odds, and if the Fed is forecasted to start cutting rates a lot faster than they currently are. This could be a once in a decade type of trade. So don't want to get anyone too excited. If you put any money into TLT or any other hedge option or anything of that nature, you'll probably lose all of your money, but there's a chance you could make some money. So I'm not a financial advisor. Keep that in mind. This is not a recommendation. Do not buy, sell, trade anything based off of what you hear in a YouTube video. This is just personally what I'm doing, and I am documenting this. And one of the first people to actually document this on YouTube, just the overall weakness that is coming to our markets. So let me know what you think about this information down below in the comments section. Are you bullish? Are you bearish? What's going on in your world? How do you think the economy is? Go ahead and vote on that poll on the YouTube account as well. In the meantime, hit the like button and subscribe to the channel if you made it to the end of this video. And if you learned something or like my perspective, at the bare minimum, want to stay up to date with information that will help you hopefully make more money. And again, link down below in the description of this video for the trading community. You guys have a fantastic rest of your day, and I will see you in the next one.